If you want to grow wealth without guessing the market, ETFs can be your steady partner. This video walks you through a simple, practical plan you can start today. Before you buy anything, ask one clear question. What do I want this money to do for me, and when will I need it? Your goal shapes everything from the amount you save to the risks you take. If you're in your 20s, you might be aiming for long-term growth. If you're closer to retirement, preservation and income could be more important. Either way, write your goal down and check it once a year. Let's keep it simple. ETFs are exchange-traded funds. They are like baskets that hold many stocks or bonds, and you buy shares of the basket on a stock exchange. They track a kind of market or theme, so you don't have to pick individual stocks. You only need to choose a few broad ETFs to create a diversified portfolio. A strong, beginner-friendly core is usually built with 2 or 3 broad ETFs and a simple rule for weighting. A very common starting mix is a broad U.S. stock ETF, a broad international stock ETF, and a bond ETF for balance. For example, you might start with U.S. stocks, international stocks, and bonds. Each component has its own role. The stock parts push growth, the bond part helps smooth the ride, and the international part adds further diversification. If you're starting from scratch, a practical target could be 60% U.S. stocks, 20% international stocks, and 20% bonds. You can adjust later based on your age, risk tolerance, and goals. The exact tickers aren't the point here. The idea is to own a wide slice of the market at low cost. Look for funds with low expense ratios and enough liquidity to trade without big price moves on your own orders. When you fund your account, make it automatic. Set a monthly contribution you won't miss, even on busy months. Automatic investing is a discipline that keeps you in the game. If you can start with $100 a month, divide it into the 3 parts to match your target 60-20-20 split. If you can do more, great. Adjust the dollar amounts but keep the same proportions. Rebalancing is how you stay on track without overthinking it. Once a year, check your allocations and bring them back to your targets. If U.S. stocks have rallied and now make up 70% of your portfolio, sell a little of that part and buy more of bonds and international stocks to restore balance. Rebalancing keeps risk closer to what you signed up for, and it forces you to buy low and sell high in a disciplined way. Costs matter a lot with ETFs. Look for funds with the smallest expense ratios you can tolerate and join a broker that charges low or no commissions. The magic of ETFs is you can own a broad market with a single click, for less money than many mutual funds used to cost. Avoid funds that try to chase a fancy theme unless you understand the extra risk and cost. The goal is a boring, reliable core, not a flashy bet you don't fully understand. Taxes are a part of investing, so think about where you store your ETFs. Tax-advantaged accounts like IRAs or 401ks can help you keep more of your gains for retirement. If you have a taxable account, you'll owe taxes on the gains and dividends. That doesn't mean you should avoid taxes, but it does mean you should plan for them and keep costs low so you're not fighting a big drag. Think of the actual process as a routine rather than a one-time event. Decide on the 3 ETFs you'll own, set up the automatic monthly contribution, and then forget about it for a while. The most important habit is consistency. Markets move up and down, but a steady, small habit over many years compounds into something meaningful. Here is a simple, concrete example you can reuse today. Suppose you're starting with no money in the account, and you decide to contribute $200 every month. You allocate 60% to a broad U.S. stock ETF, 20% to an international stock ETF, and 20% to a bond ETF. Over 30 years, with an average annual return around 6%, that habit can grow into a substantial amount. The math isn't a promise, but it shows the power of time, consistency, and broad diversification. If you increase the monthly amount to $500 and keep the same allocation, you'll reach a much larger sum over the same period. The exact figures change with market movements, but the principle remains. Small, steady contributions, kept low cost, well-diversified, and invested for decades, tend to work well. To make this practical, here is a simple plan you can follow in the next week. In the next day or two, decide your goal and time horizon. If you're under 35 and aiming for long-term growth, a 60-20-20 split can be a good starting point. If you are closer to retirement, you might tilt toward bonds, maybe 40% U.S. stocks, 20% international, and 40% bonds. Open an account with a broker you trust. Compare fees, ease of use, and customer support. You don't need a perfect choice. You just need a reliable one you'll stick with. Once you have the account, pick your 3 ETFs, one broad U.S. stock fund, one broad international stock fund, and one broad bond fund. Confirm their expense ratios are low and that daily liquidity is acceptable. Set up automatic monthly contributions. If you can start with $100, $200 or more, put it on autopilot. Make the transfers automatic on the day you get paid so you don't have to remember. Schedule a yearly rebalance reminder. Put a note on your calendar for a calm, relaxed review every 12 months. Decide in advance what you'll do at that time so you don't have to decide in a panic. Keep an eye on costs and taxes. If you're using tax-advantaged accounts for retirement, that's ideal. If not, plan for capital gains taxes when you rebalance or sell. Remember, the tax part is about planning, not avoiding, so keep your costs as low as possible and stay long-term. Build a simple dashboard in your head, not a mountain of numbers. Track a few key things: the total balance, how much you've contributed, and your rough allocation. Don't get lost in daily price headlines. Focus on the big picture over months and years. Common mistakes to avoid are straightforward. Don't chase the latest hot ETF or sector. That kind of move usually ends in regret for beginners. Don't try to time the market by picking moments to buy or sell. Time is your friend when you're investing for decades, not a few days. Don't skip the boring parts like the rebalancing and automatic contributions. The boring parts build wealth more reliably than a fleeting excitement. If you're unsure where to start, here is a quick action checklist. Write down your goal and time frame. Choose 3 broad ETFs to match your target split. Set up automatic monthly investments. Schedule a yearly rebalance. Leave room for small adjustments as you learn. And most importantly, commit to starting now, not later. By sticking with a simple, repeatable plan, you turn investing into a habit rather than a gamble. You don't need to be the fastest reader of the market. You just need to be a steady, consistent saver who stays the course. The core idea is to own the market in a cheap, transparent way and let time do the heavy lifting. As you grow more comfortable, you can add layers if you want. Some people gradually introduce a small tilt toward value or momentum, or add a 5th ETF for a specific region. Others keep the core to 3 funds forever and use a separate account for specialized goals. The key is to keep it simple enough to actually do day after day, year after year. To recap, investing in ETFs for beginners goes like this. Define your goal, choose a simple core of broad ETFs, automate your contributions, rebalance annually, mind the costs and taxes, and stay consistent. The plan is boring, but boring works when you give it years to compound. Real wealth rarely arrives from a one-time move. It grows from repeated, quiet decisions. If you found this plan helpful, take a moment now to like this video. If you want more of these practical guides, subscribe to the channel and hit the bell so you don't miss the next one. And I'd love to hear from you in the comments. Tell me what you want to learn about ETFs, or share your own first-year experience with this exact approach. Your questions help shape the next video. Thanks for watching.